The Borrow Smart segment today being brought to you by GetHomeSelect.com. GetHomeSelect.com, the absolute best home loan on the market. You know what's scarier than your teenager getting their driver's license? The insurance bill that comes with it. I am Ron Siegel, Certified Liability Advisor, helping families build wealth through strategic debt management. Let's talk about something that hits every parent's wallet hard: adding a teen driver to your insurance policy. I had a family come to see me recently, and they were in shock. Their insurance company quoted them an extra $3,200 a year to add their 16-year-old daughter to their policy. That's over $260 a month. Here's what most families don't realize. This is an insurance review trigger moment. When you're about to add a teen driver, you need to shop your entire insurance package, not just accept the quote from your current company. So what should you be thinking about first? Well, let's look at the big picture. Adding a teen to your policy will increase your premiums. That's just reality. But how much depends on several factors you actually have control over. The car matters. The sporty coupe your team is dreaming about, it's going to cost you a lot more to insure than a safe, reliable sedan with a high safety ratings. I've seen families save $80 to $100 a month just by making a smarter vehicle choice. Here's another consideration. If your teen is driving an older vehicle that isn't worth much, you might not need comprehensive or collision coverage on that specific car. Why pay to insure a $3,000 vehicle for damage when your deductible is $1,000? In some cases, dropping that coverage can save $40 to $60 a month. Now let's talk about discounts most families miss. Good student discounts can save you 10 to 25% depending on the carrier. Driver's education courses can knock another chunk off your premium. And if your teen is away at school without a car, occasional driver or pleasure-only discounts might apply. But here's where strategic debt management comes in. When your insurance bill jumps by $200 or $300 a month, that affects your household blended interest rate. If you're carrying credit card debt at 24% interest while paying higher insurance premiums, you're getting squeezed from both sides. I had another family, let me call them the Johnsons, who came to me with this exact situation. Their teen driver insurance was going up $275 a month, and they were carrying $18,000 in credit card debt. We looked at their complete financial picture. They had equity in their home, so we repositioned that high interest debt, freed up the cash flow, and they could actually afford the insurance increase without stress. Here's what this family saved. They were paying about $360 a month on those credit cards. After repositioning, their mortgage payment went up $140 a month, but they eliminated $360 credit card payment. That's $220 a month in positive cash flow, more than enough to handle the insurance increase and still have money left over. And here's the important part. They shopped their insurance at the same time, found a carrier that gave them better rates for the same coverage. Between the debt repositioning and smart insurance shopping, they turned a $275 monthly problem into a $150 monthly savings. Remember, insurance should be reviewed every couple of years anyway. When a major life event happens, like adding a teen driver, that's your signal to shop. Your current carrier knows you're a captive audience. They're counting on you not wanting to go through the hassle of getting new quotes. But that hassle could save you thousands of dollars a year. And when you're already dealing with increased costs from the teen driver, every dollar matters. Now, here's a strategy that really builds wealth over time. A lot of families keep low deductibles, $250 or $500, because that's what they set up years ago when money was tight. But if your financial situation has improved, raising your deductible to $1,000 or even $2,500 can significantly lower your premiums. Let's say raising your deductible from $500 to $2,500 saves you $400 a year in premiums. Here's an educational example, and I am not a financial advisor, so this is not individual financial advice. But consider taking that $400 annual savings and putting it into a Roth IRA. You're essentially self-funding your increased deductible over time. After 5 years, you got $2,000 sitting there growing tax-free. After 10 years, you got $4,000 plus growth. You've covered your higher deductible and you're building wealth at the same time. That's the safety, liquidity, and return framework in action. You need the safety of proper insurance coverage, but you also need the liquidity to handle a higher deductible if it makes financial sense. And the return is the money you save on premiums that can be redirected to wealth building instead of draining. Now, I know some of you are thinking, Ron, I don't have a good insurance agent, or I don't know where to start shopping for better rates. Here's the thing. We work with trusted insurance professionals all across the country. These aren't people who are going to charge you fees. They're compensated by the insurance companies just like any agent, but they'll actually shop multiple carriers for you and review your coverage to make sure it fits your situation. If you're anywhere in the sound of my voice and you need an introduction to a quality insurance agent who will give you a second opinion on your coverage and rates, reach out to me. I can connect you with someone who will take the time to understand your situation and find you the best combination of coverage and cost. Let me give you some action steps. Before your teen gets their license, get quotes from at least 3 different insurance carriers. Ask about every discount available: good student, driver's education, multi-vehicle, bundling home and auto. Compare not just the rates, but the coverage limits. Cheaper is not always better if you're sacrificing important protection. Look at your current deductibles on all your vehicles. If you're in a better financial position than when you first set those, consider raising them and redirecting those premium savings into a Roth IRA. The premium savings add up fast, and you're building your financial safety net at the same time. And here's the bigger picture. If you're adding your teen drivers, straining your budget, that's a sign to look at your complete household finance and cash flow. What other monthly expenses could be reduced? Where are you paying high interest rates on debt? Your household blended interest rate includes everything: credit cards, car loans, personal loans, and yes, even inefficient insurance spending. Strategy beats rate always. You could have the lowest mortgage rate in your neighborhood, but if you're overpaying on insurance and carrying high interest credit card debt, you're not winning financially. If you want to get your financial house in order and see where you really stand, visit rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. We'll help you look at your complete financial picture, not just what you're eligible for, but what's actually suitable for your situation. Because adding a teen driver doesn't have to derail your financial plan. With the right strategy, you can handle it without stress and maybe even improve your overall financial position in the process. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. And that's the Borrow Smart segment, brought to you by GetHomeSelect.com, GetHomeSelect.com.